The UK resides in a complex transition period. The EU referendum vote of 2016 was a catalyst of the uncertainty that exists today, triggering tremors in the political landscape, an unexpected general election where the Conservative Party failed to win a majority, resulting in further sterling weakness. Inflationary pressures and the potential of a rise in interest rates may harm an already fragile UK consumer. The UK equity market has proved resilient to geopolitical and economic uncertainty. The FTSE is up over 5% year to date, with the mid and small cap indices outperforming, both registering double-digit gains. Markets ended Q3 2017 higher, though there were a few sharp risk-off days, mainly due to tensions between the US and North Korea, still heightened with the latter continuing its nuclear weapons testing program. Hurricanes battered parts of the Caribbean and Florida, resulting in oil prices at two-year highs. Strong Chinese demand buoyed commodities and Eurozone growth reached five-year highs during August. Sterling is off its seven-year lows against the euro, but remains volatile. Aided by hawkish comments from the MPC, the Monetary Policy Committee, the prospects for the first interest rate hike in over 10 years move closer. With unemployment levels at their lowest level for 40 years and inflation comfortably ahead of its 2% target, sentiment appears to be shifting towards higher interest rates. On the other hand, UK growth remains modest, not aided by EU negotiation uncertainty. It remains to be seen whether recent productivity numbers and a fall in new car sales delay future interest rate rises. In September, the MFM UK Primary Opportunities Fund managed a modest gain of 0.1%, outperforming the UK equity market, which fell by 0.4%. Over the quarter, the fund produced a solid return of 2.4% compared with 2.1% for the FTSE All-Share, placing the fund in the top quartile over 1 and 3 years. With the holiday season behind us, we are again seeing a significant number of attractive primary opportunities, and with markets in solid shape, we are anticipating a busy period ahead. There is currently much focus on how the UK consumer is faring. Wage growth has been minimal for a decade, with inflation running at levels in excess of pay rises. The UK consumer has held up relatively well despite all that has been thrown at it. Record employment rates and low interest rates have kept consumer spending going. We do not profess to have a crystal ball, but with interest rates certain to rise at some point in the future and unemployment unlikely to go significantly lower from these levels, UK consumer spending is likely to remain under pressure. Ever since the unexpected EU referendum result, we have looked to reduce our exposure to large ticket UK consumer companies. Motorpoint, DFS and Dunelm have all been sold. In hindsight, this proved to be the correct decision, reflected in recent data from the SMMT, the Society of Motor Manufacturers and Traders, the Car Industry's Trade Association, a bellwether for consumer confidence. It showed new car sales have fallen 6 months in a row. This does not mean we do not see areas of value in the consumer spending sector, but we remain focused on smaller ticket discretionary items which people are less likely to cut back when personal finances are stretched. We participated in the IPO of Hollywood Bowl in 2016 and this year the IPO of 10 Entertainment. They are the number 1 and number 2 operators of 10-pin bowling sites in the UK. Both businesses offer modern facilities superior to the independents they compete with and are using technology to make booking simpler and drive higher usage rates. Both are cash generative, dividend paying, modestly valued and trading well. Exactly the type of opportunities we like to hold in the MFM UK Primary Opportunities Fund. In an economic downturn, we expect both companies to hold up well as consumers will still allow themselves and their family affordable treats. Two other companies that we also have in the portfolio exposed to smaller ticket item UK discretionary spend are the Gym Group and Everyman Media. The Gym Group is the UK's second largest low-cost gym operator, where the average monthly subscription is below £20. Everyman Media is a cinema operator with smaller sites in more affluent areas. Both companies are fast-growing and cash generative. Again, in a downturn, we anticipate consumers will still continue to want to keep healthy by going to the gym and allow themselves a treat by going to the cinema. We are always looking to protect the downside, and tweaks to our process have achieved the desired results. By using our primary opportunities process to buy into companies at a discount, we have a margin of error not available to most investors. We are buying into companies when all known information has been made available at a fixed price, typically free of stamp duty and commission. We look to buy into companies that are profitable, not expensively valued, and pay dividends. We like quality companies that are market leaders or have a niche allowing them sector-leading and dependable margins. Companies that perform well and exceed expectations, we look to run. Those companies that underperform or the headwinds in their industry are too great, we will look to exit. Markets are currently in a buoyant mood, and we believe there is potential for further gains in this long-running, though unloved bull market. There is still value in areas of the UK market, backed by an attractive and growing dividend income stream, and a majority of earnings coming from outside the UK itself. Nevertheless, we are always mindful of a downturn and market uncertainty. We have been increasing the defensiveness of our portfolio by the purchase of a number of property REITs, Warehouse REIT being an example. This was a compelling opportunity to participate in the IPO of a UK warehouse company. It is focused on urban areas, so its warehouses are smaller than the likes of Segro and Tritax Big Box. Warehouses have been the best performing part of the UK property sector over the past few years, and this is expected to continue as online retail continues to grow. The shares are forecast to pay an attractive and fully covered dividend yield of 5.5%. If a sharp market fall occurred, we would look to raise funds by selling our more defensive holdings, which we anticipate would outperform, and use some of the proceeds to buy larger companies where we felt fools had been overdone and offered compelling value for the longer term. We might also see some primary opportunities from distressed sellers. In times of extreme market volatility, we like to hold high levels of cash. The important thing to remember during a market downturn is that we would continue to keep faith in those quality companies that we hold, in the belief that markets can overreact in the short term, but over the longer term, valuations in quality companies will recover. In addition to the purchase of low-ticket consumer stocks and the more defensive play in Warehouse REIT, we also participated in the successful IPO of Charter Court Financial Services, a challenger financial services company specialising in mortgage lending to the buy-to-let and specialist residential market. The shares floated at a discount to the sector, as we would expect when purchasing at IPO. Given their track record since forming in 2008 and their class-leading return on equity, we anticipate this discount will disappear as management deliver on their strategy. Private equity retains a majority stake, so we anticipate further primary opportunities in the future. There were also secondary sell-downs in Just Group by private equity and Hargreaves Lansdown by one of the founders. The former was formed in 2016 by the merger of Just Retirement and Partnership Assurance. It is a market leader in non-standard retirement benefit solutions. The shares were purchased at a 6% discount. Hargreaves Lansdown, a market-leading financial services company with a private investor, were purchased at a 3% discount. Whilst not a cheaply valued stock, it is a genuine market leader in a structurally growing sector as people are increasingly having to make savings provision for the future. It is now one of the largest active holdings in the fund. The important point is both are market leaders in their sector that exceed our qualitative and quantitative screening process. Both were purchased at discounts to the prevailing market price, affording protection for the fund in the event of a downturn in markets. We took some profits in our holding in Angling Direct, which is the smallest company in our portfolio by market capitalisation, having gained more than 30% since IPO. We took the opportunity to reduce our holding and await further news flow on their progress, having recently made a substantial acquisition. Acrol, a toilet roll manufacturer, had served us well since we purchased at IPO. Nevertheless, with weak sterling putting pressure on its margins and new contracts not appearing as quickly as we hoped, we saw potential downside risk, which has been borne out since our sale. Johnson Matthey was also sold, a long-term but relatively unexciting performer which had seen sentiment weigh on it over diesel car emissions. Recent results reassured the market and we took the sharp increase in price as an opportunity to sell our holding. Finally, 1PM, one of the smallest companies in our portfolio, was sold after a solid set of results and together with being tipped in a national newspaper which provided a price rise and some liquidity to take profits. Whilst the valuation remains modest, with the recent purchases of Hargreaves Lansdown and Charter Court Financial Services, both larger and more diversified financial services companies, we considered it prudent to exit the holding. At a busy time of year, we are currently seeing a substantial number of primary opportunities, a number of which we may look to invest in, and we'll keep you updated in due course. Thank you.